What if I told you there are exactly 2 indicators that called every single major market bottom of the last several years? Not 3, not 10, 2. And by the end of this video, you'll know how to use them better than 95% of retail traders out there. Let's get into it. Okay, so here's the deal. Most traders have 17 indicators on their chart. RSI, MACD, Bollinger Bands, Ichimoku clouds. It looks like a Christmas tree. And you know what? They're still losing money. Meanwhile, the pros in Wall Street, they're watching firstly 2 things. 2 most obvious for everyone components of the market. The EMA and VIX, the exponential moving average, the EMA, and the VIX, the so-called fear index. That's it. And today I'm going to show you why this combination is basically a cheat code for catching market bottoms. Quick crash course. The EMA is a moving average that gives more weight to recent prices. Think of it as the market's gravity. Price always wants to come back to it. They usually act as support levels. You may ask why. When Goldman Sachs, BlackRock, or Citadel deploy their algorithms, they need a metric that reflects the current behavior of major players, not an average snapshot from 3 months ago. That's exactly why the EMA has become the de facto standard in institutional trading. Also, when millions of traders and hundreds of algorithms are watching the same EMA levels, those levels become genuine support and resistance, simply because everyone is reacting to them. This is market reflexivity in its purest form. The 4 EMAs that actually matter: 20, 50, 100, and 200. And the magic happens on the daily, weekly, and monthly timeframes. EMA 20, the short-term pulse of the market. On the daily timeframe, it reflects the average price behavior over roughly a month of trading. This is the level strong trends return to during healthy bullish phases. Most high-profit swing movements happen here on 20 EMA. For example, during the 2023-2024 bull market, SPY bounced off the 20 EMA on the daily chart more than 7 times in a row. EMA 50, the defensive line of the midterm trend. Many portfolio managers use it as a trigger for rebalancing. An S&P 500 drop below the daily EMA 50 often triggers partial profit taking by institutions, while a confident hold above it signals trend continuation. Also, S&P 500 consistently reacts to 50 EMA weekly as support level with continuation of the trend. EMA 200, the main marker of bull versus bear market. The phrase trading above the 200-day EMA is not just a technical term, it's an inclusion criterion for institutional portfolios. Many funds have an outright prohibition on going long in assets trading below the daily EMA 200. This creates the most powerful, self-sustaining support level in the market. Apple is perhaps the most beautiful example of respect for the EMA 200 on the weekly timeframe. Look at the history since 2016. Every major correction, in late 2018, in March 2020, COVID, in January 2023, ended with a bounce from the weekly EMA 200 with 1-2% precision. Why? Because the largest funds, from Berkshire Hathaway to Vanguard, hold AAPL in their portfolios and use the zone as an averaging point. When price touches the weekly EMA 200, accumulation algorithms kick in. This isn't magic, it's the mechanics of money flow. Now the VIX. This is the expected 30-day volatility of the S&P 500. When traders panic and buy puts to hedge, the VIX spikes. When everyone's calm and greedy, it crashes. And here's the key. The VIX moves opposite to the S&P 500 about 90% of the time. That makes it a perfect contrarian tool. Memorize these VIX levels. Screenshot this, tattoo it on your forearm, I don't care. VIX 12 to 15. That's complacency. Markets are euphoric, S&P 500 usually bounces off the 20 EMA daily. VIX 15 to 20. Normal market conditions. This is where you get clean bounces of the 50 EMA daily on S&P 500. VIX 20 to 25. Caution zone. Watch the 100 and 200 EMA daily on S&P 500. VIX 28 to 35. Fear is real. Historically, these levels have given the best swing entries of the past decade. VIX above 40. Full-on panic. It's very rare, but every time it's happened recently, it marked a generational buying opportunity. Alright, now let me show you the receipts. 4 real examples, 4 times this combination printed money. December 2018, Powell scares the market. S&P 500 drops nearly 20%. On December 24th, Christmas Eve, VIX above 30. It hits 36, and S&P 500 taps the 200 EMA on the weekly chart at exactly $234. What happens next? Boom! plus 25% in 4 months. March 2020, COVID. The world is ending. VIX above 40 level. Explodes to 82, tied with 2008 for the highest level ever. And S&P 500? It hits the 100 EMA on the monthly chart on March 23rd. Anyone who recognized that combo caught one of the greatest bull runs in history. SPY literally doubled in 5 months. October 2022. Bear market lows. Terrible news about inflation in the US were published. October 13th. VIX above 30. QQQ, second largest ETF behind S&P 500, taps the 200 EMA weekly around $254. S&P 500 taps 200 SMA weekly. From there, plus 45% rally to July 2023. While CNBC was screaming recession, this signal was screaming buy. April 2025. The tariff panic. VIX rips above 60 again. The main weight of the stock at that time, AAPL, collapses straight into the 200 EMA weekly. S&P 500 almost touched 200 EMA weekly. Same script, same outcome. The market bottomed right at the confluence. 4 examples, 5 years, same pattern. This isn't coincidence. This is mechanics. Here's exactly how I trade this. Take notes. Step 1. Read the regime. VIX under 15, buy shallow dips at the 20 EMA daily. Like in 2024 on S&P 500. VIX between 18 and 25, watch the 50 and 100 EMA daily. VIX above 30, activate crisis mode. Focus on the 200 EMA daily and the 50 EMA weekly. Look for consistent patterns on VIX at resistance levels. Step 2. Wait for the VIX spike and reverse. This is your trigger. Look for a massive green VIX candle with a long upper wick, followed by a red VIX close the next day. Or for example, look for a wick candle on weekly or daily time frames on VIX. That single pattern has marked dozens of short-term bottoms. If that reversal lines up with an EMA touch or EMA hammer candle on S&P 500, that's your entry. Step 3. Size up when the VIX is extreme. Bigger position size on the rare panic setups where VIX is above 35. Smaller position size when VIX is sleepy. Risk-reward asymmetry is everything. The best trades of your career will come from the scariest days. 2 things before you run off and put your life savings into S&P 500 calls. 1. VIX doesn't tell you how deep the drop will go. In March 2020, the 200 EMA daily got sliced through. The real bottom was on the 100 EMA monthly. Always have a plan for the next level down. For example, your stop loss should be 1 or 1.5 ATR below certain EMA which you're trading. 2. Don't fight the early VIX rise. When VIX goes from 14 to 18, the correction is just starting. Don't catch the first knife. Wait for the spike, the reversal, confirmation with candle pattern like wick or doji candle, and the EMA tag or EMA hammer candlestick. Patience pays. Here's the bottom line. Markets are a battle between fear and greed. The EMA shows you where the institutions value price. The VIX shows you how far the crowd has emotionally drifted from that value. When price hits a major EMA and the crowd is terrified, that's when smart money buys from scared money. It worked in 2018, 2020, 2022, 2024, 2025. And it'll keep working as long as humans trade markets. So your homework. Try to pull up S&P 500 or QQQ. Mark the 20, 50, 100, and 200 EMAs on the daily, weekly, and monthly. Open the VIX in the side panel. Look for consistent patterns on EMA plus VIX at resistance levels. I promise you, you'll start seeing the market the way the pros see it. If you like the video, then join Market Mind community in Discord. There, I'm giving more educational information, weekly and daily technical analysis of the market, and of course, free signals. See you there and good luck.